Okay, guys, wanted to do a quick interest rate update. I had a few people asking me, a few friends that were loan officers asking me about rates and what I think. And so I figured I would just record it and post it everywhere just so everybody else could see it. Just because I feel like we're all kind of in a difficult time. If I could do anything to help or change perspective or save somebody from making a mistake, I know plenty of people have done it for me. So I'd like to do the same in return. So, that being said, if you've ever watched any of my videos, you know that I went back and basically I've been talking a lot about how we broke out of this is in, so it goes all the way back to the 80s. In 2022, right here, we broke out of a nearly 40-year downtrend. I think it was 38-year downtrend in interest rates. So, meaning in our entire lifetime, for the most part, interest rates have always gone down and always gone lower because they all traded in this range. And for those of you who don't understand stocks and charting and all that stuff, basically everything always trades in a range for the most part, and a channel and has trends. And you don't have to be, some type of chart expert to understand this. Now, you can see for nearly 40 years, we honored this trend downwards, right? Well, in 2022, something significantly changed. We broke out of that nearly 40-year trend and started a new uptrend. Okay. So, with that, one of the things I want to warn people about is, and I'm doing this because I see a lot of loan officers posting out there about, oh, interest rates are going to come down. They always do. Well, yes, they always have for 40 years, but now it might be a little bit different. And I'm not saying they're not going to come down. I just want you to be safe rather than sorry, because you could potentially get yourself in a bad situation or, at minimum, ruin your reputation. And that's not good for any of us. So, at the end of the day, what I want to show you here is in 2022, we broke out of this 38-year downtrend, right? So we started this new uptrend right here in 2022. I'm going to zoom in here a little bit so you can kind of see this a little bit better. We started a new trend upwards. Now, this isn't perfect. I just kind of threw this together, but I just want to give you a couple levels to look at. And we are looking at a 10-year treasury. That's the easiest way to track where interest rates are going to be, as they do follow the 10-year treasury 100% of the time. That's not what the rate is. There's always a spread, but you get the point here. So in 2022, we broke this 38-year downtrend and started a new uptrend. Okay. Now, I didn't chart this one quite perfectly because, like I said, I threw it together. However, this is something that's been concerning me a little bit and why I've been so hesitant to talk a lot about lower rates and they're going to come down and all this stuff. There's a lot of other factors we can get into on a different day. If you want specific, have specific questions, you can always reach out to me. But with this, I was never convinced that we were going lower until I saw this uptrend get broken. Okay. And you can see right here where my mouse is that uptrend broke here around see August 1st or 2nd, somewhere in that ballpark, towards the end of July for the most part. And the chart I had originally had was about right here. Let's see, let's go back. This is the original section that I had put off here. And so where I started really thinking, okay, maybe we could go lower was actually around towards the end of June, beginning of July. That's when we really broke that uptrend that we had been in for a while. And you can see, it always trades off these channels and it always goes up and down in these channels, just like it did for the last 38 years. So we broke out of this around that time. And we've kind of been in this no man's land for a little bit. Okay. Right in this area. Now, one of the things that concerns me, I'm kind of a market nerd, and there are a lot of big money, big name guys shorting bonds, that anytime the 10-year treasury goes up, the price of bonds goes down. So they're actually betting that the 10-year treasury is going to go up, which is going to drive interest rates up. And a lot of the reason for that is because of inflation. Inflation is more than likely going to spark again. If you've seen any of my posts, I've been very critical about Jerome Powell and cutting rates too soon, and too much. And I think he's going to spark a lot more inflation. Inflation, to make a long story short, inflation is really bad for mortgage rates because if you have, let's say you're going to buy this asset and it's going to return you 5% over a 30-year period. Well, if inflation is 8% or 10%, that was a horrible investment. Your investment can't even outpace inflation. So with that being said, it's bad for mortgage rates Not to get too far into the weeds, but that's kind of a basic explanation. Now, when we started this, there's been a few levels that I've been wanting to look at. One big level I knew that we were at is like a 3.661. I kind of knew that we were going to bounce off this level, and as you can see, we have bounced up and down off this level a lots and lots of times. In the stock market, there's a saying that says range bound is the rule and a breakout is the exception. And so typically stocks repeat history. Any asset repeats history. Any chartable asset typically repeats itself and stays in a range. Anytime it breaks out, it is an exception, as you saw with that last 38-year downtrend. So this 3.6 level has been a really, really big level. As you've seen, we've hit it lots of times in the last, in the last 2 years. We've hit it quite a few times. The next level that I'm really looking for that I think could be significant is this 3.847 level. It is a big level of resistance, meaning that we've hit it on the ceiling a lot and gone back down. So this is support and this is resistance. Currently, anything below 3.661 would be below support, and anything above 3.853 would be resistance. It'd be above resistance. So it'd be a breakout. So right now, I am thinking that we are going to stay in this range for a little bit, this 3.85 to 3.6 range, which means you're not going to see interest rates move more than 0.25% for now until we have a breakout outside of this range. I'm going to start trying to post a little more about these levels that I'm, kind of keeping an eye on. And again, these are not perfect. I just threw these together. But if I was a loan officer right now, I would be, I am, but if I was another loan officer, I would be extremely, extremely careful about floating interest rates right now. There is a lot of big money guys betting against mortgage rates. A lot of like Stanley Druckenmiller is a huge whale, and he is betting largely against mortgage rates, which means he thinks they're going up. And that would mean inflation takes back off, which would make a lot of sense. You have the strikes at the port, you have government spending still out of control. Government spending is what causes inflation. Another thing is that with the hurricanes, especially in the Carolinas, that shut down a lot of interstates that might not be open for another year and a half, it's going to really mess up logistics. If you think back to 2020 with supply chain problems, that's a lot of what helped cause inflation as well. So we're going to have a lot of supply chain issues coming up with the strike and a lot of the interstates being down. So just be very, very careful if you're floating interest rates. If this 10-year breaks above, 3.85, I would be locking everything I possibly could. And I'd be very careful telling clients that rates are coming down right now because there's still a lot of uncertainty in the markets. Not to say they won't, but there's still a lot of uncertainty in the markets right now. And I would just be very careful of that and very cognizant of that. So hope this helps at least one person today. And I hope you guys have a kick-ass Thursday. See ya.